in all the major ETFs of late. That's been pretty interesting. And on top of that, how about what was going on just the other day with the volatility index? People were buying the VIX calls. They were buying the 50 strike calls, 95,000 of those going out to July. So gives me an idea that people are
in 2008. The reason for all this turmoil, inflation clocking in hotter than expected in May. Move in rates, the 2-year Treasury yield surging above the 3% mark for the first time since all the way back in 2008. The reason for all this turmoil, inflation clocking in hotter than expected in May. The jump so jarring that now not one, not two. I'm channeling my inner LeBron James right now.
3.
But we're talking about banks, not championships. They're calling for a 75 basis point rate hike at the Fed meeting just next week. So with a more aggressive Fed and a continually volatile market, I like that Steve's nodding. I appreciate that support. How should investors set themselves up right now? Tim Seymour, you're over there. You just started nodding. I'm going to go over to you.
I'll nod. And first of all, it's a somber day, but it's an exciting day to have you at the NASDAQ, Frank, for the first time on Fast. Awesome. Great to have you here.
This is where he corrects you. It's like, this is not my first time.
Well, first time in that chair. Yeah. First time in that chair doing that thing. It's awesome. Great to have you. And it's a day when, look, I know that equities are front and center, and we have some levels on the S&P, certainly a closing level that's back to those lows. Didn't get to the intraday low of, I think, 38.11. Steve probably knows that number by heart. But I think the most important dynamic was obviously not just the inflation number. You had a Michigan confidence number that was not just a low number, but the lowest on record. And so, you know, as you led in, Frank, and talked about not one, not two, but possibly 375s, the Fed's never hiked with consumer confidence below 60, let alone at 50. And if you think about the dynamics around the numbers today, what was probably most alarming about those inflation numbers is the services side of the inflation story is the one that I don't even think we've really have had yet. And so then you get the dynamics around, you know, that Goldman downgrade of Netflix. Maybe we'll talk more about it. Maybe we won't. But the point is that now talking about consumer stocks, or at least consumer spending in the context of higher inflation, what are they going to give up? And that was part of that downgrade. I'm not sure I totally agree with that, but that's the dynamic that comes on a day like today. And again, technically, we're going to talk about this later in the show, too. I think we have some levels that are starting to point to.
All right, now I'm sorry.
It was just terrible price action today. And to Tim's point about Michigan sentiment, one more thing on that. You also had longer term inflation expectations increased to 3.3%, which is what the Fed will really look at to say, are long-term inflation expectations unanchored is the term they use. So when you hear that, what does that mean? It means the Fed's going to have to raise rates a heck of a lot more. And I think 75, if it was me, I'd do 75 basis points on Sunday night and shock the market.
Well, that's what the market probably thought today, right? So the market was pricing in a 75 basis point hike for next week, figuring, well, they're going to get ahead of it. But the Fed pretty much all but took off 75 basis points as a hike. Mm-hmm. So I think the market has to readjust, but I think the R word is creeping in. I've been Mr. Negative. I've been Mr. Recession.
Yes, nice job.
By the way, the first quarter was negative growth. The second quarter is tracking negative growth. The textbook definition is 2 quarters of negative growth. The only thing we don't have is a rise in unemployment rate. So that still shows that people have some green in the pocket.
All right, Pete, we got a pessimist right here. Pete, you're in the trophy room. A lot of trophies, not a lot of winning today on the market, though.
No, not too much winning at all, as a matter of fact. But you know what I think it comes down to, guys, and I've been on this for a while now, is just the absolute inverse relationship we've had with the 10-year. And now you can actually throw in the 2-year. Take a look at the velocity of the move for the 2-year, where it was under 250 just at the end of May, and here we are over 3. And when we see that, we see the immediate algorithmic selling hit when we see either the 10-year or now the 2-year over 3. Boy, the selling just comes absolutely incredible. We had it yesterday late in the day. We had it all day today. And I think it's something we got to keep an eye on. We're all talking about the CPI. We all know those numbers backwards and forwards. It's unbelievable. But at the same time, it shouldn't be something that was unexpected. It should have been exactly expected. We all know when we see the pump. We all know when we look at nat gas. You look at wheat. You look at corn. We look at all these variables. We should know that this was going to be a pretty awful number, and it certainly lived up to that, Frank. So I think it's one of those things where I'm surprised where volatility is. We priced in the weekend, but we were well over 29 on the VIX, pulled all the way back towards 28. It's going to be an interesting week next week. We did have volume finally return in the derivatives market. We were over 50 million contracts today. 2 days ago, we were 33 million, just as a comparison. So we did see some volumes finally show up, and that might be a good sign.
So I want to get back to this rate hike issue. We just flashed just a second ago on the banner. Barclays and Jefferies forecasting a 75-point basis hike. Yep. The estimate for inflation was 8.3%. So if we would have got to that 8.3%, would we have avoided a sell-off? I mean, 0.3% doesn't seem to be that big of a difference.
I just think on the headline number and a lot of that 10% rally we had on the S&P off of those May lows into where we really started selling off again earlier in the week, I think was a function of the sense that inflation wasn't so bad. So these headline numbers, by the way, even if you think about where the comps were, conceivably you have a chance for this to be looking like, and people were talking about peak inflation. I think on some level, Steve's been saying something about that. And I just, talking about the interest rate dynamic, and Pete brought this up, I don't think we can underestimate the fact that the 2-year note is at a level that it hasn't been since the pre-GFC. So global financial crisis, we're talking October 2007, dollar at 20-year highs. I mean, these are signs of extraordinary moves and dislocation, and that to me is what concerns me. We had an ECB meeting today, and I know we don't really care that much about the ECB, but we think our Fed is behind the curve. And by the way, if you look at where Fed fund futures are and where the shadow funds rate is and where the inflation rate is, that differential, the Fed's never been this far behind. The ECB is not even in the stratosphere, and the Bank of Japan's on Mars. I mean, if
Thanks, not championships. They're calling for a 75 basis point rate hike at the Fed meeting just next week. So with a more aggressive Fed.
Good morning, everybody. We're going to replay this, and then I'm going to stop at certain points here making comments about their comments. So let's just see here.
I'm going to go over to you.
I'll nod. And first of all, it's a somber day, but it's an exciting day to have you at the NASDAQ, Frank, for the first time on Fast. Awesome. Great to have you here.
This is where he corrects you. It's like, this is not my first time.
Well, first time in that chair. First time in that chair doing that thing. It's awesome. Great to have you. And it's a day when, look, I know that equities are front and center, and we have some levels on the S&P, certainly a closing level that's back to those lows. Didn't get to the intraday low of, I think, 38.11. Steve probably knows that number by heart. But I think the most important dynamic was obviously not just the inflation number. You had a Michigan confidence number that was not just a low number, but the lowest on record. And
so this is a huge thing, right? Because for me, the number that we got yesterday morning wasn't that big a surprise, is the reality. I think that everyone has known this. Just go to the gas tank, right? Or go to the gas pump, I should say. You don't have a gas tank in your backyard. But this is the reality, is that, you had a consumer sentiment number which has never been recorded. Never.
As you led in, Frank, and talked about not one, not two, but possibly 375s, the Fed's never hiked with consumer confidence below 60, let alone at 50. And if you think about the dynamics around the numbers today, what was probably most alarming about those inflation numbers is the services side of the inflation story is the one that I don't even think we really have had yet.
And here's the issue, is for me, it's not only the headline, but the ripple effects still aren't correctly, necessarily fully incorporated into the world. And this is what I was talking about. You can see another video on the channel where it's called Inflation Takes No Prisoners. I'll try to have a link in the text once we're done. And this is what I was saying to Art, which is that he's talking about inflation. And this was 2 months ago, where I was basically saying, look, we don't understand the actual way that actual valuation and decisions actually get made. Thus, stocks for show, bonds for dough. And that is kind of what is being leaked on here. And it is coming, of course, now in market prices.
Then you get the dynamics around, that Goldman downgrade of Netflix. Maybe we'll talk more about it, maybe we won't. But the point is that now talking about consumer stocks, or at least consumer spending in the context of higher inflation, what are they going to give up? And that was part of that downgrade. I'm not sure I totally agree with that, but that's the dynamic that comes on a day like today. And again, technically, we're going to talk about this later in the show too. I think we have some levels that are starting to point to.
All right, now I'm sorry.
It was just terrible price action today. And to Tim's point about Michigan sentiment, one more thing on that. You also had longer-term inflation expectations increased to 3.3%, which is what the Fed will really look at to say, are long-term inflation expectations unanchored is the term they use. So when you hear that, what does that mean? It means the Fed's going to have to raise rates a heck of a lot more. And I think 75, if it was me, I'd do 75 basis points on Sunday night and shut.
Okay, so this is, these guys are talking quickly, and they're sliding in these extra points that, they don't have time to delve into every sentence that they're saying, right? But I do want to point this one out here, which is we have had a world where everyone has been clamoring for Fed transparency, that the Federal Reserve would telegraph what they plan to do. I candidly have never thought that was a great idea. I don't like the idea of transparency by the Federal Reserve. And actually, I vehemently disagree with it. Because it's kind of like, you know how you went to high school or junior high? Teacher comes up and says, okay, pop quiz. And the reason for the pop quiz, right, is to make sure that everyone's doing their homework on a day-to-day basis and keeping up and just not studying for the final exam, right? Which is that piece by piece, a gut check needs to be taken. And by making it too transparent, the Federal Reserve has taken away the threat of a pop quiz. And this is the problem. When you add that to the fundamental misunderstanding about stocks for show, bonds for dough, right? When you take away the idea that, hey, we're controlling R down here, which is the interest rates. And they needed to be able to pull out a weapon. And it goes in both ways. In other words, what they've done, what I don't agree with, the way the government runs things, and, they're not calling me, right? So let's give it a grain of salt. But the reality is that they shock and awed by throwing tons of liquidity, by making money free, by driving R straight down. How did they do that? COVID relief checks. How did they do that? They bought a third of all mortgage-backed securities, a third, right? And now basically telegraphing R to be down. And that has allowed people to have happy talk about the numerator. Why? Because the R was down and stable and transparent. The issue here, though, is it had to have worked the other way. Meaning that what it did is it also gave a sense of complacency. So that people just said, okay, well, I'm be able to spend as much as I want. I'll be able to take out tons of credit cards. I'll be able to do this. I'll be able to do that. I'll be able to borrow from the bond market and buy back my own stock. Right? And thereby pushing up the stock prices higher. Oh, yeah, by the way, board's compensated on stock performance for sure. Well, the issue is here now, by not having the reverse, meaning that the threat of higher interest rates, they also kind of skewed it too far the other way. And this, in a way, is what this past commentator, right, Brian Kelly is his name, is referring to. Because basically what he's saying is, look, yeah, that's all well and good.
The market.
Well, that's what the market probably thought today. So the market was pricing in a 75
but we
basis
needed
point hike for next week, figuring, well, they're going to get ahead of it. But the Fed pretty much all but took off 75 basis points as a hike. So I think the market has to readjust. But I think the R word is creeping in. I've been Mr. Negative. I've been Mr. Recession.
For some reason, it's not showing up, and don't ask me why that is. I have no idea.
Tracking negative growth. The textbook definition is 2 quarters of
There we go.
negative growth. The only thing we don't have is a rise in the unemployment rate. So that still shows that people have some green in the pocket.
All right, Pete, we got a pessimist right here. Pete, you're in the trophy room. A lot of trophies, not a lot of.
We better be right. He better be right here, which is that, that people better have money in their pocketbooks. Now, we've had reports of higher credit card openings at a rapid rate and savings declining rapidly. And of course, this is the point of why consumer sentiment is lower, right? Which is that, hey, the checks have run out, they're running out, my cost of borrowing is higher, the cost of gasoline is now, as you can see, $5. For the first time ever, this is the highest it's ever been, as you can see here on the, now I'm not going to read this to you, but basically you can see in California, most expensive state, prices are as high as $6.43 a gallon. So in other words, the headline of what actually came out yesterday wasn't that surprising, right? I mean, we kind of knew this. What we didn't know was how the market would react. And this is, kind of one of your takeaways, of course.
No, not too much winning at all, as a matter of fact. But you know what I think it comes down to, guys, and I've been on this for a while now, is just the absolute inverse relationship we've had with the 10-year. And now you can...
And of course, to readers of the newsletter, to Jay's Corner, this has been my point, which is, stocks for show, bond for dough, where now all of a sudden we've got R so much higher that it's pulled down then, of course it has, right? It's simply pulled down the NPV. Well, what's the NPV? That's the value of a risky asset, whatever that risky asset, including your house, by the way, of course, including your house.
Actually throw in the 2-year. Take a look at the velocity of the move for the 2-year, where it was under 250 just at the end of May, and here we are over 3. And when we see that, we see the immediate algorithmic selling.
And over the past 2 weeks, we have seen relative choppiness, but relative stability and boring in terms of stock markets. Why? Because as you can see from this graph here on this screen, that the 2-year note, for example, and this is the interest rate on the 2-year note, had been pretty stable. So it's not only that rates are higher, but that it is fluctuating around to this degree. Because when it starts fluctuating around, basically what's going to end up happening, and clear, right? You're getting bigger disagreements about the feedback loop to the numerator and therefore to the NPV. So it's not only that R is higher, right? R slowly, predictably higher, right? In a controlled fashion, we could get used to that, right? We could get used to $4 gas, okay? As long as it didn't happen for overnight. Right? You could build up for it. You could plan for it, et cetera, et cetera. Would that necessarily make the NPV higher? Not necessarily. The question is whether or not, okay, we're going to pay for, 20% more for a box of Cheerios or 25% more. If it came in increments, you could say you would not have this degree of unsettlement. Not that said, we don't have that at the moment, creating more volatility.
Hit when we see either the 10-year or now the 2-year over 3, boy, the selling just comes absolutely incredible. We had it yesterday late in the day. We had it all day today. And I think it's something we got to keep an eye on. We're all talking about the CPI. We all know those numbers backwards and forwards. It's unbelievable. But at the same time, it shouldn't be something that was unexpected. It should have been
and should have been. And this is really the issue, is that as in anything, right? I mean, we're going to get a consensus. I'm not going to be the person to tell you, oh, well, CPI is going to be higher than the forecast. That's really not my call. That's not my job. I wouldn't try to do that. There are experts out there who are measuring it, estimating it, know what the components are, get different data points, staff to create their estimates, no problem. The issue is that, okay, well, how does the actual market then react to news? So first of all, because this isn't that far different from, it was higher than the forecast, but it was not like, 50% higher. This was within spitting distance of, for me, what the consensus was going to look like. But what was surprising was the actual reaction. And it, like he said, just over the past day and a half, this was not really evident through Wednesday, only at the very end of Thursday into Friday.
Exactly expected. We all know when we see the pump, we all know when we look at nat gas, you look at wheat, you look at corn, we look at all these variables, we should know that this was going to be a pretty awful number, and it certainly lived up to that, Frank. So I think it's one of those things where I'm surprised where volatility is. We priced in the weekend, but we were well over 29 on the VIX, pulled all the way back towards 28. It's going to be an interesting week next week. We did have volume finally return in the derivatives market. We were over 50 million contracts today. 2 days ago, we were 33 million, just as a comparison. So we did see some volume.
And a lot of that 10% rally we had on the S&P off of those May lows into where we really started selling off again earlier in the week, I think was a function of the sense that inflation wasn't so bad. So these headline numbers, by the way, even if you think about where the comps were,
these are some stunning numbers, obviously.
For this to be looking like, and people were talking about peak inflation. I think on some level, Steve's been saying something about that, and I just, talking about the interest rate dynamic, and Pete brought this up, I don't think we can underestimate the fact that the 2-year note is at a level that it hasn't been since the pre-GFC. So global financial crisis, we're talking October 2007, dollar at 20-year highs. I mean, these are signs of extraordinary moves and dislocation, and that to me is what concerns me. We had an ECB meeting today, and I know we don't really care that much about the ECB, but we think our Fed is behind the curve. And by the way, if you look at where Fed fund futures are and where the shadow funds rate is, and where the inflation rate is, that differential, the Fed's never been this far behind. The ECB's not even in the stratosphere, and the Bank of Japan's on Mars. I mean,
and this is the issue. So when I have been saying stocks for show, bonds for dough, what it really boils down to is these bigger markets are largely unknown and underappreciated. And only when it starts becoming volatile, only when it starts to become a problem, oops, we actually have to pay attention to the bigger markets. And this is actually what this person is talking about here. Right? You've got the dollar, and you've got the dollar at the high as people are trying to get to risk off. And in addition to that, you've got other central banks raising rates. It's not only a U.S. matter. That's all I'm going to say here about, kind of the news here and what actually happened, over the last couple of days. What I'm going to do is I'm going to take a look at, let's just take, as I've been saying on other broadcasts, this is a question about, and I don't have that mug here, how much people are willing to pay, right? So the financial markets, the stock market included, of course, is not here to prove that you're smart about, the denominator or the numerator. It's there to find a clearing price for this, what someone is willing to pay for my Winnie the Pooh mug. Here's the S&P 500. I have made this point that what ends up happening is some people, the detractors, would tell you, okay, these just look like random lines. Except if all the people with all the money are looking at the lines, then all of a sudden you've got to pay attention. And you can see, not surprisingly, that I've been pointing out certain congestion zones, and of course this is a watered down version, and we are back now here to something that stretches back to basically the pandemic, to a year, more than a year ago. More than a year ago, that now all of a sudden we are having this disagreement that stretches all the way back here, which means we've gained no ground here. And this is why sentiment is such a problem. Because asset prices here haven't changed for the better part of 15 months. Yet you saw from the prior, and where was it? You can see here, with these numbers this much higher, right? So now your assets aren't worth more, but your costs have increased by that degree. And this, of course, is, rightly so. This is rightly so the cause for concern to many. And here we go now where we are taking a look at what are possible other congestion zones. You can see right here where we were. Not only here, but also all the way back to here. I don't find this a coincidence. The issue is much lower than here introduces down here. And by the way, the persons who have been fundamentals, people who are like, hey, look, there's a person from Morgan Stanley, the strategist. The strategist is not calling, day to day what strategy is about long term. Okay. And the issue here is that a strategist from Morgan Stanley was alone who had said, look, these higher interest rates are not, and basically what he was calling for, right? And now he's taking his victory lap, and he deserves it, right? I mean, he certainly has earned that, which is that, did I blow it away? No, I didn't. What he basically said is higher interest rates would create problems where now all of a sudden the earnings decline. That the consumer would stop spending, and that the company's costs would rise, and they would not be able to pass it on to consumers, therefore pushing down the C1, which is their earnings. And even if the world wanted to pay the same multiple for the market, which is an entirely different layer that I've not yet discussed, right? I've not yet discussed something called equity premia. That will be on a later broadcast, well beyond today's scope. That even if you stuck to the an average market multiple, because the C's would be dragged down as a ripple effect of higher R, that the result would be back down to, for that particular person, he assigned it not coincidentally, all the way back down to this zone here, 3,400, which is another 500 S&P points lower from here. So let's just take a look. So 5 out of 39 Okay, so 5 out of 39 is another 13% lower from here. Now, I'm not going to tell you that this is right or wrong, right? I'm reflecting how these people these different information sources are looking at the data. Okay, so I've used a fair amount, 20 odd minutes or so to try to talk about the past few days and what these different scenarios possibly look like, right? Because ultimately, you're still here. We're back always to here. So the idea that we can go up is certainly there. The idea that we can continue to travel down, and what type of degree. What I'm really trying to show you about those congestion zones is I'm trying to give you a perspective on how wide the probability distributions look like on the far right edge of that screen, right? The far right edge of the screen is telling you, okay, how steep, where do these tails fit out here? Because this is just showing you in standard deviation terms. But it's not really showing you, okay, well, if we stretch out, how far lower are we looking? Well, I'm showing you here. You keep stretching out and you're all the way down to 3,400, which also, by the way, coincides with what the Morgan Stanley person was saying. The negative, meaning I put a minus sign behind everything that Mike Wilson from Morgan Stanley has said, and you could go the other way, right? Meaning that, yes, back up to these congestion zones, right? Some people have been calling for that. So in other words, what it meant, and you can see where they were talking. They were talking about right around in here, which is, this 4,300, the last time where we had this kind of like disagreement, right? Disagreement on the cost of the open price of this, well, today in my, 90% completed bottle of water. The reason that I'm showing you it in this way, right, is to give you an idea on how wide this blue bell curve actually is. How far the extension is on the up. How far the extension is on the down. And from there, we begin to Jay's corner and how it affects you. So we begin now, right? I mean, that's not, of course, at all what I'm, I'm not here to be a market, person, meaning in the sense of I don't have a crystal ball. However, what we can do, and you can see for yourselves, is a long time ago, and these still sit up on the Maximize Your Medicare channel, are these two videos here. Which is what's important to you is how much your holdings are moving. Right? And you get a glimpse into that here. So here we are back to the BlackRock, and you can see nasty, right? Minus 16% year to date. It's a very difficult year, even for the best of class. And again, BlackRock here, which is, quite detestable. I'm going to show it to you here, this is Vanguard. And here there are different dates of funds, and you can see it down here. Made it bigger for you. Minus 15.85. Oh, minus 15.97. Right smack on top of each other. Right? That's 0.12%. 12 cents on $100. Right? 12 cents on $100 is all they're different for the entire year, despite all the crazy up or down. In other words, they're using models and they're adjusting those models and then their allocation. You can see I'm not going to get into whether or not this is right or wrong, right? But you'll be able to see it in here. Portfolio characteristics, and then you're going to have their largest holdings here, right? And exposure breakdowns here, none of which I believe, by the way. And by what I mean by I don't believe is not that they're telling you untruth. No. I find like zero chance of that. This is not about truth or untruth, factually. This is, however, a question of how you are doing, how your plan is changing, how your balances are. So that you can take a look and say, okay, let's say we get to these extension points. Let's say we get to, up to 4,300, where would you expect your balances to be? If we go down to 3,400, where do we think the expectation of your balances to be? And then for you to determine whether or not you can stomach it, that degree of up and down. And this is the missing element. In other words, to different people, they're going to have different viewpoints. right? Because of the facts that since they have an estimate of how they're doing, in other words, if the market moves up or down by 10%, as you could see here by these congestion zones, now how much are you going to be affected? How much of your decision making is going to be affected? Whether or not you're going to feel how terrible you're going to feel or how good you're going to feel if these go up or down. That is not really something that you can have a single article in Kiplinger's and just kind of, because I'm just going to say that my neighbor's down by 20%. I'm down by 15%. I feel much better about that. That generally, in my experience, isn't the way this works. Right? You're not. Oh, so you're beating the other. You're beating the Joneses by 5%. So do you feel that much better? Not really. So it's really a question about the individual and what they are thinking, what you think, and what you think you can stomach if we are headed down to this, and at what points are you going to be adjusting or not. Unfortunately, what you have in these articles online, in the press, which includes other planners, don't get me wrong, right? Is they say, okay, well, stocks in the long run. Yeah, I'm not disputing any of the historical data here, or in the stocks in the long run we're going higher. That also means we can go lower. I just can't reiterate this enough. This is, that crowd, the brokerage crowd, is paid by the fact that you are keeping money there. You have to remember that. That's the inherent nature of the businesses as they are currently constructed. Let's keep going. So yes, I looked at these two family funds, as many people are aware of. Right, so BlackRock minus 17%, 16%. Fund filters right on top. You can see here that different persons at different age divisions in 401ks, you may have chosen a different fund, and you can see it here. What I find stunning, and this is the next segment, is what I find stunning here is the fact that someone retiring 10 years earlier is only 0.6%. No, it's just 1% different. I'm just a guy. Okay. And even down to 2025, you're talking about 1.8%, which is the difference between 15.85 and 14.0. I'm just a guy. That's true. But when I see these numbers, I see something strange. And I've known that this has existed, and this is really the point of this second segment, which will take about 10 minutes, the next 10 minutes. There is an element when they're creating these portfolios that people don't get told about. And I've long suspected this to be true, which is that the reality is that these funds, in a market which has been straight higher as a result of stable and lower interest rates, because of that, and the fact that this is a very competitive world, right? I mean, it's not as if these two are not watching each other, right? Clearly they are. Why are we this high? The only way, right, working backwards, the only way to get to these numbers is a huge allocation to equity. Huge. And you can see it here. The asset allocation for this fund seems to be 78.4% stocks. Which for someone who's planning on retiring in 18 years, at 80% stocks, that may have been fine coming out of the financial crisis, perhaps after a couple of years. how you've continued to ride it to this degree is okay. It can be explained by trying to keep up with the Joneses. Let's see what these guys have to say. That's not it. You'll see that this fund, in addition, right, is sitting with fees, holdings, exposure breakdowns. You know, very difficult for everyday people to try to pick through here. So this is kind of why I've kind of measured this by these two videos. Please go and see them. Right? Which is that I've actually given you, to the degree I could, breadcrumbs on how to actually look through data that is this confusing, because it's difficult for everyday people to just look at the summary statistic, which is this singular number here, and know what's going on underneath the surface and how it affects you, right? Because that's all I care about. That's all I care about. It's revealed kind of here. So this is just from this, a couple of weeks ago, I want to say. Wall Street Journal showing you the stock market hitting many 401ks harder this time. And this is, in fact, correct, which is the fact that I've known. That that doesn't make these solutions wrong, but there are limitations, and it's sitting in here and here, which is these funds, proper retirement plan, etc. I subscribe to the Wall Street Journal, so I'm showing you this. Pretty sure I'm not supposed to. Target date funds creating this. And now you can see, and while I'm okay here, and you can see it here, portfolios for the youngest workers now invest 92% of contributions to stocks, up from 85% a year ago. A decade ago, with some top-selling target date funds nearing 100% stocks at the outset of the investor working life, according to Morningstar Inc. I'm not necessarily saying that that is wrong, even conceptually, right? If you're early 30s with a promising career here, and I were like 80-20 or whatever, it is a reasonable strategy to be, because your runway is long, right, at 30 years old, this makes sense. And now you can see here, 45 portfolios for 45-year-olds, 82% in stocks, okay? At retirement age, median exposure is 46, up from 43. This is actually okay. Except these numbers tell you a lot higher. These numbers tell you a lot higher. While you can see there's a displacement here. That these target funds, right, may have been, in order to get your attention in a market where stocks have been one-way train due to lower interest rates, are running way ahead of where this stuff is. And this is kind of this point here. She expressed particular concern for older investors given they don't have as much time to make up for market declines. This is correct. And this has kind of been my point here. This is a Morningstar, an analyst who target date funds. Which is, I've been showing you this as a result of the benchmarks, right? So on how to set your expectations. Like, for example, in 2022, they were nowhere near the plus 25%, right? Because that they had bonds plus stocks, bonds being actually, flat to worse in 2021, sorry. And now you've got it here that what's actually in here is much more in stocks than other people might think inside of here. All of that's still okay. Still okay. And I'm going to say now, and let's just pull up Drive. I'm going to shut this off for just a moment, I think. Yeah, I'm going to shut this off for just a second because I can't show you all of the, if there's any private information on there, I don't want to be revealing it. That'd be a bad idea. Okay, so let's take a look at the spreadsheet here. So I've done this exercise in the past, and I'll do it again here for people because I think it's super valuable to many who've not really yet considered in this way. They should be, but that's not the way it works, right? So we've got Mr. X, and we've got income, and here we have Social Security, possibly pension. And then we have withdrawals. Let's just call it, individual account. And this can be brokerage or bank. I don't care. And then we've got qualified funds. And this is, IRA, 401k, in general, right? And of course, we've got, and then we've got expenses. And we've got, cost of living, insurance, housing. Okay. So you can see clearly what has happened, right? It could not be more clear that this number here, and let's just call it, 1,700 times 12. I understand that. But then you're taking a pension of which is going away by many people. It's called 300. Now, the question is in here, right? You're pulling in these numbers in order to deal with, right? And now all of a sudden, the A's, B's, and C's start increasing by 15%, as you could see from that graph that graphic that I showed you from Fast Money. This is 2022. And now we go to 2023. Oops. Right? And on we go. So what ends up happening here is we've got some numbers, and this number is going to be increased, right? Clearly, CPI, running at this 8%. So you can expect a Social Security increase next year. I think that's pretty much, in the bag. Your pension number isn't, right? That if you've locked in a pension number, this number is 300. So if you have a pension and you are receiving it, and then there's extra, and we'll get to the extra later. AB, these numbers here that I've highlighted, that I'm going to highlight, right, in the blue, are now increasing at 15% more. 10% more. The most visible being gasoline, clearly. Housing. Food. The question is whether or not you're going to be withdrawing increased amounts of monies here. Now we've got balances down here. Right, and let's just take this as your non-qualified. And for those, that's your individual stock accounts, et cetera, because you've already been taxed. And this is, qualified funds is the 401k, IRA. Roth IRA, you've already been taxed, so it's actually not in there. You can put Roth here. That's fine. Right, so what you have here is, and let's just call it I. The question is whether or not, let's make them purple. Here and these purple are lower. and they're lower by this degree. Okay. And so you're now trying to see whether or not you can have this bump through time in these different years. Well, how are you doing that? You can push down these to some degree, right? You can push down the blue to some degree, and many people are going to, and this is, of course, has the feedback loop to earnings at the company level, right? Companies won't make as much money if you stop paying for, stuff. Or cost of living. Okay, under cost of living. You start pushing down your A, guess what? The feedback loop is now to the numerator that I was talking about at the first segment. And now you can understand why these ripple effects matter. Okay, so what we have here is we've got Mr. X and we've got Mr. X here. And now all of a sudden, we have to start withdrawing more amounts out of here. Why? Because we've withdrawn monies from here. So now these balances X and Y are lower. So now you've drawn down some of XXXX or YYYY, right? You've drawn down here with stocks down here, right? So if we recover back up to here, now you can see sequence risk in full flight, right? So not only has the gone down, and then you're spending more money at that time, and then when it goes up, since your balance is depleted, you don't get the full run up back to XXXX. This is sequence risk with the extra whammy of inflation. And that's why the separate video, inflation takes no prisoners. Right? Because it's the second effect, not only of just, it's a bummer to watch your account balances decline, but you're also having to pay for other stuff out of, how do you solve for this? Yeah, this is why, so saver's revenge here. Right. So the savers, okay, I've oversaved, I've missed the rallies, and stuff like that. Yeah. Well, now you don't have to withdraw from here. Now you can ride these, have more cushion to see if we're going back up. Now that doesn't mean that you don't stop comparing. I just don't have this. I'm not in the camp of someone says, okay, well, look at my account balance, once every 6 months. And the plain and simple reason, right, is that, yeah, that ignores this. That doesn't make sense to me. Now, that doesn't mean you have to be watching it every hour. And practical reality is most people don't, have time to be, day trading. And even when you're doing day trading, you can see that I've shown other videos here to actually show you how professionals actually do it. It's not like you're going to be able to replicate their activity. But what you do see up here on this untitled spreadsheet is the fact of why what's going on in inflation and in financial markets matters, because now it has this ripple effect on the blue lines and these purple lines down here. And whether or not, and the fact of the matter is that this tells you that even in here, it's harder this time because more heavily invested in stocks than many investors think. Third segment. Right here, I took a look at this tool, and this tool, so now the question is, okay, in the link here, right? So you can see over here, I'm thinking to myself, okay, well, how long can this stuff last? And which is a very, very common, a very common thing, right? You're thinking to yourself, okay, how do I actually make this last? Is my money going to last? Right? Are we going to keep going here? And I'm going to keep going here till I'm 150 years old. There are tools for this. And here is Western and Southern. So again, I'm choosing best of class intentionally, right? I'm intentionally choosing the best of class. I'm not choosing, Jim Bob's, I'm not choosing Jim Bob's, calculator.com, Jay's Corner calculator.com. I want to show you other highly credible companies with tools and useful reference points with limitations. Right? Before the market events over the past couple of days, I was actually going to just create this video, but instead here it's now here live here on Jay's Corner, and you can see it here. Thankfully, I looked at my OBS and thankfully my microphone's on, something that I've not done correctly in the past. Anyway, that's because I'm terrible at this. Anyway, if you take a look at the retirement calculator, this is a good website. I'm going to leave the link in the text. Let's just see. Do I even? No, I can't do it yet here. So, let's see. So what this does is this is based off the 4% rule, and that's why they started here. So what happens is you start with X plus Y plus Z maybe, right? And for me, I'm looking at an extras, and we're going to put in W's here, kind of as your punchline. But let's just say we're going to add X plus Y plus Z. Right, and what ends up happening is oversimplified tools, good 4% withdrawal. And now they give you and you can see what has happened is that you're combining it with, okay, well, what's happened here? More invested in stocks than you realize. So you go through here, and then you choose your horizon. And out comes some kind of estimated success and failure rate. I'm not entirely sure what to make of the implied message of success or failure actually is. Right? I'm going to leave my editorial comments here, to the side, because what I'd first start to say is I'm not sure if I would use this, this wording. But what I am saying is that this means that you have an estimated 8.3% chance money will last 20 years, 11.7% chance it won't. This is a bit alarmist for me, to be candid with you, because, some of them, where you stand depends on where you sit, right? This seller is a seller of annuities and insurance, right? Life insurance. High quality meaning, as far as their financial stability and resources to pay their obligations, amongst the highest in the country. And then what you have here in the small print, right, is some description of success rate and how they created these numbers. I don't find them to be wrong. Okay. Meaning that they have tools, and you can see here a couple of things. Success rate, percentage of simulations resulting portfolio greater than zero, allocated stock component is the Russell 3000 of the entire U.S. stock market. Bond component is Bloomberg USA Aggregate Band Index, which is the ticker AGG, something that I've shown to you on Jay's Corner in multiple locations. Meaning, again, I'm not using pie in the sky numbers. I'm giving you very good, highly quoted, commonly used benchmarks so that you can rationally set comparisons. I don't want you to compare apples to kumquats, right? I want apples to apples comparisons for you. And here it is. Monte Carlo analysis. For those who don't know, basically Monte Carlo analysis is, you can see it here. Let's see. An analytical tool method simulating random returns of uncertain variables to obtain a range of possible outcomes. It is not, of course, coincidence at all that you have the watered down version of this. So the reality is that here on Jay's Corner, I'm actually giving you intuition, reasoning on how the guys with unlimited computing power are creating their output. This isn't guesswork, right? There's a difference between estimation and guesswork, right? We don't call a person who has created a hurricane model by hand as pure guessing, right? If you thought that they were purely guessing, you ignore every hurricane forecast, right? That doesn't sound like a good idea. Why? Because you know that those persons have a framework by which to create some outcome models and expectations, of which are reported here to you. It just so happens to be a particular example of what I've been showing you the entire time, right? Meaning that this Monte Carlo analysis, that's fine. They've attached fancy language to it, which is not wrong. Don't get right. I don't want to be mistaken by calling someone like a quack or some like voodoo doctor. No. By no means. And again, there's your commonality of why I'm choosing best of class. Right. And again, vary with use and over time, not a guarantee, prediction, or projection of any particular result. Oh. Once again, you can see me pausing of the language here in the red. Right, we can attach these different simulations, pathways, portfolio outcomes. And I've talked about the strategy, but the point is, without caring whether or not, Meta is a buy or a sell here at whatever, $170 odd a share, right? There's nothing to do with that. But instead, what by far the dominant feedback loop to everyday people. And everyday people can be sophisticated people. Just because you have a bigger number as X plus Y plus Z, I promise you this is not being followed. Last week, I said that it's never too late to adjust, and that makes complete sense given this, right? Meaning because you're starting here at the red, there's still always time to adjust. Now, whether or not that's necessary is up to the person. Of course, emails to me on, my thoughts in your particular situation available, of course. And that is my most valuable service by far. I've not done a very good job of explaining it at all. I do a terrible job of explaining what I actually do. But the reality is here, right? Which is to kind of help you piece together X, Y, Z, A, B, C, I, double I, triple I through time, right? And again, a columnar snapshot here for me is just not that interesting. I need to see what we're going to go over here as we march through time, because then and only then am I thinking through, okay, now my eyes here, what happens under these different types of under different types of what? Scenarios. So now we're back to here where we're thinking through, okay, what happens under these different scenarios here, and what is its ripple effect to here? So that the X's and Y's don't go to zero. Okay, so this is in a nutshell what I'm actually doing under the Comprehensive Financial Planning Service. And now you can see how these little elements I'm trying to show you step by step. And I understand, everybody wants the answer in 10 minutes. You can see here how complicated it is. That each individual step may be, everyone's like, oh, I understand what's in my individual account, what's taxable or not, which people don't. But then, they think they have a handle on it. That's only, a particular piece of the jigsaw puzzle. For persons with savings, this segment here is that now, to the delight of many, they've been waiting, right? They've been waiting. That now all of a sudden, ZZZZ is now higher. Oops. So now you can see what has happened is that, no, I'm a moron. That what has happened here is these extras are now higher. And not only are they higher, that they don't depend on market conditions. And so in here by extra, and now you can see why I've tried to show you the other videos on this channel about annuities, explaining annuities and insurance. That it's higher, that higher interest rates is feeding through to higher numbers here on these two balances. And when you combine, for some persons, I am very certain that what has happened is they start seeing that their balances are seeing to what degree you can swing up and down, because these different nodes can be household net worth balances. They realize, oh, guess what? This curve is no longer this narrow little curve where stocks are straight up because interest rates are so stable and lower. This is that one-way train has stopped and reversed, you could say. So as a result, your risky balances now, that curve is flatter, wider. The up and down is bigger. The variability is increasing. Volatility is increasing. No question, right? And this is not heroic statements. It's not scintillating analysis either, right? That's me being Captain Obvious. Agreed. But then in that instance, what is happening to you here and what is then happening to you here, you realize, you know what, I can't stomach this. The question is down here, these two elements down here are now yielding. They are absolutely now yielding better than they have in the past. These two, the Z and the W, these numbers are now definitely higher. Now, this isn't going to make me popular with Joe Broker, right? This statement's not going to be popular. You're selling at the low is what somebody's going to say. I'm going to, let's just see here. I'm going to shut this off. Sorry. Right? In other words, you can have determined, which you can determine at any point in time, right? I can't take the up and down. The good thing here is that these two columns, these two lines, these two rows, 10 and 11, cash and extra, these now are starting to yield stuff. It's not zero any longer. And if that's you, then when you add that to your knowledge that this can always still traverse both up and down, this is why I continue to tell persons, look, it's not too late to change your mind. Most of the time it's because, people have not understood this. People have not understood this. Right? People have not understood this. So, but now, and I'm not here to tell you, okay, well, you should have been listening to me for years. No, that's not it. What I'm saying is, okay, we're here right now. I can't put us into the time capsule. We're here today. That doesn't mean that we can't adjust. It could be you're 30 years old and you say, okay, well, I think stocks are all rigged. Well, guess what? The reasonable may be you need to have bigger exposure to equity. You could actually very clearly see the rationale and pathway. Why? Because your possibility for higher returns on investments are better today than they were in November November of last year or January of this year. You bet you. The denominator's lower. The cost per share is lower. So your potential for upside is higher. That doesn't mean it can't continue down. No, it doesn't. But you have more time. You have more time, as right. Seeing over here, obviously, you're 30 years old. Okay, you're different than if you're 70 years old. Right. Again, not splitting atoms. Not splitting atoms. But the hard part is to then take good account of what's going on in these line items, which is why I don't have a problem with a 30-year-old, plugging this with influencer. You can hear me have said this in the past. And I don't care what it is. Gig economy. If that's your maximizing thing to get through time here, so be it. So be it. If you're 73 years old, you're the idea that you would, switch course and become an influencer at this age, not as likely. Not as likely. So I thought to show you this tool because so these tools exist. This is not the only, right? You can see how, very strong, very strong. This is like I said, amongst the highest credit rating that, these tools are good from this, but you can see while they're using very good analytics and they have unlimited computing power, what they don't have here is the idea that, okay, if I have this planned, right, now all of a sudden I'm withdrawing from here, not 4%, but 2%. And now all of a sudden, right. And how did that happen? Because they had this extra cushion here. And it also tells you that this is, a little bit short-sighted, right? Because this presumes that there's no cash. Meaning it presumes that everything's in, a bond plus stock portfolio. Like, is shown up, in here. And so you can see what ends up happening. The tool isn't wrong. It is instructive to some degree. That said, you can see what ends up happening, right? That it's not complete because of the fact that properly, fully planned out means that what you may have thought was going to be, I have to withdraw 5%, creating this kind of success rate. Oops, I don't have to, because when the market's down 30% from the NASDAQ high, that, I've reduced this and now all of a sudden I'm at 100%. And you can see how valuable then. First of all, you can see the shortcoming in this tool. You can also now see, because of the fact that we've slowed down the withdrawal rate, right, and changed it to 100% from taking 1/5 out, where now you have, a 25% chance of not succeeding. how valuable, in fact, we are to hear. The issue here is inflation has created this situation where the withdrawal from here is more likely now because of the fact that Social Security and pension, your income isn't meeting your expenses in the future. And that's your full feedback loop. Last point here, and I'm going to be brief. June is, as I pointed out, June is Prevent Medicare Fraud Month. And let's just see this thing and see if we can try to play it here.
Come to work and see all of this, for something.
Let's see if we can go all the way here.
Now to another tragedy. This one, a deadly fire in South Hackensack, New Jersey. An elderly mother.
I wonder if I can. Blah, 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 blah. Go broke dates, push back. None of this, no problem. There you are.
And it can't come too soon. Medicare scams are exploding, costing New York State taxpayers $5 billion each year. The deception is easy to detect, but you must know where to look. 7 on your side, Zita Pineda has one New Yorker's story on how she foiled the fraud.
Jean Stone's a fashion guru, a blogger, an influencer, but now she's unfortunately adding a new title to her many monikers, Medicare fraud victim.
And they list a cardiologist that I've never met, never seen.
Jean was attending a Project Runway party before Christmas and needed a negative COVID test, so she went to her neighborhood pop-up in Soho for a test.
Just nasal swab, yep.
But when she got her explanation of benefits from Medicare, it listed she was seen by a doctor, a heart doctor no less. Billed $200 for a new patient outpatient visit and $300 for the test.
All right, now here, I have no doubt that this happens. Okay, I have no doubt this happens. I have seen it. That I've seen healthcare providers try to bill Medicare for things that they could not do, did not perform. This isn't New York specific. This happens in every location. So by all means, please check your explanation of benefits to make sure that it correctly matches. Even if you're on Medigap, for example, and you've met your Part B deductible, right? What is happening here is that the insurance company then is paying, let's just say you have Medigap. You've met your Part B deductible. This thing happens as in that video clip. What would end up happening? Your bill is $0. That's true. But a couple of things can happen. Number one is if you try to change Medigap carriers and this is on your medical records, this can be a flag when you don't need a flag because, you didn't have to see, they'll ask, okay, they'll call the cardiologist in that particular video clip. Well, if there's been no necessary, examination, why is this even showing up on your records? The second thing is that even though the Medigap carrier will pay, if in fact it's been approved by Medicare, since the claims of the entire pool would be higher, that means your Medigap premium increases next year will also be higher. Okay, if you were the only person in the pool and you went to the doctor and you got billed, but you didn't have to experience it because you already met the Part B deductible, that the carrier would pay the doctor or the hospital, whatever it would be, the healthcare provider. But next year, when they go to premium increases, not because of the fact that you face that claim in 2022, but they're using that as a projection for what your health care cost needs will be in the future. And from there, they create the premium. Oh, hello. That looks a lot like they're doing this. Of course they are. Of course they are. So my point here is that for persons, if this happens to you, that your explanation of benefits doesn't match with what you expected to see, please challenge it. Please challenge it. And this can be part of the explanation, by the way. And this is not an excuse, as you followers know, right? I'm trying to give you even-handed pros and cons. Part of this is that, and now you can understand why this. So while on one hand, right, you'll see stories about the fact that Medicare Advantage carrier, and I pointed it out in the past, that Medicare Advantage carriers have prior authorization. There's a reason for the prior authorization as well, right? There's not just one side to this coin where the people who are saying, well, Medicare Advantage is a scam because they're denying procedures that are vital. The flip side is from that video clip, which is if you are billed wrongly and they get paid for it as a result, that basically is wrongdoing. And so excessive testing, excessive procedures can happen at every level, irrespective of whether or not you're on Medigap or Medicare Advantage, on both. So the Medicare Advantage plans have reason for prior authorization. Now, does that mean that Medicare Advantage plan carriers are holier than thou on every single matter? No, it doesn't. I'm just stating that it's very complicated and not as one-sided as, our extreme society would have you believe. Either way, I'm not saying that Medicare Advantage is the holy grail. I can tell you what the reason for it is: to push down the systematic cost curve by becoming the reference price setter. Is that how I should? The setter of the reference price? Either way, I guess any combination of those three words actually makes sense. But absolutely, right? Trying to drive down the reference rate for physicians and hospitals to try to push down the overall healthcare costs of the United States. I don't think there's any doubt that that is on the agenda, right? It also explains the idea of privatizing Medicare. And that's going to be my last point. I have seen this. I've seen this headline over the recent days. Blah, blah, blah. Pressure to shut down Trump era Medicare. And, you can see it here. Privatizing Medicare. Pilot program to reboot for Biden, etc. And now you can see, let's just use this one because it's the, probably most credible of the big journalism groups. And yes, you can see, that there's been this pilot program. I don't think this has to do with what I've just stated, which is the Medicare system trying to keep its trust funds solvent, a matter that I don't think that it fails. Repeat everything I've said in the past. I don't retract anything, but you can also see its motivation but it is naturally motivated to try to keep it solvent under the weight of 63 million Medicare beneficiaries. This pilot program looks like ACA, here it is, the transition to ACO REACH model will begin January 1st, which is a very double-edged sword. it certainly has a rationale, right? Which is, we have a convoluted healthcare delivery system, which is an a la carte, piecemeal by piecemeal, line item by line item delivery mechanism. That's true. The flip side to that is that the primary care physician who is on holistic overall care would say, delivering healthcare in this manner, one by one, line item by line item, is not a good thing for someone's overall health. I'm not a medical doctor. That was my late father. Don't call me a doctor hater. Right? Which is that they're saying, look, that's just one component, your checkup, but there are these other components. And those other components should be taken into account. That all makes absolute sense, right? Primary care physicians certainly, and I'm not saying every primary care physician, I've heard this, and that is the way it works. That said, that reasoning works. That said, there's a reason that it doesn't work that way, which is that Medicare doesn't work that way, right? That it's in a piecemeal, line by line fee for service, and that is what this is trying to address. We're not going to come up with a solution here today. I haven't weighed in really on what I think here entirely on what this is. This is what happens when you have a democracy, right? You don't have a czar that everyone can agree on and being handed, allowing the czar, him or her, to lay down the law and for everyone to agree. The country is too splintered, fragmented for that, with stakeholders who are too big and too smart just to allow themselves to get run over. Back to my first statement, which is, of course, where you stand depends on where you sit. As always, have a good weekend, everyone. Questions, comments, please leave them here on the video. Please like and subscribe to the channel. It does help the algorithm. This channel is not monetized. There are not enough, there's criteria. I'm not sure if we're even ever going to get there. Certainly Maximize Your Medicare, the two channels between the two. Please like and subscribe to them both. That way we can keep these different topics separate, right? I'm probably going to clip out this second part and put it on the Maximize Your Medicare channel. But you can see that, what I'm really doing is looking at a widest variety of financial topics here for all age divisions. Have a good weekend, everyone.